Chair, do you want us to start the housekeeping comments? Thanks.
Thank you for participating in today's meeting. If attending in person, please do not connect to Zoom or teleconference while in the room, and please silence all devices. If translation is provided, click on the globe at the bottom of your screen to select either English or Spanish. Public comment will be taken after each item. If you're in the auditorium and wish to comment, please use the iPads located in the lobby or complete a blue speaker card as available. If you need assistance, please find a South Coast AQMD employee. Speakers may be limited to a total of 3 minutes or less for all agenda items. Times may be shortened to ensure all speakers can be heard. A countdown timer will be displayed on the screen for each public comment. More time will be allotted for Spanish translation that is not simultaneous. For questions or issues on making a public comment, please call the public advisor at 909-396-2432. That's 909-396-2432. Please adhere to the speaker time limit and treat others with courtesy, civility, and respect. Failure to do so can result in your mic being muted or you being removed from the meeting. Be aware that this meeting is being recorded. By participating, you authorize recording of audio and visual content presented during the live event and consent to subsequent use of the recording in the public domain by South Coast AQMD.
Thank you for those instructions, and welcome everyone to our Friday, September 12th Hybrid Investment Oversight Committee meeting at the South Coast Air Quality Management District. I'll officially call this meeting in order and ask Jenny Pierce to please call the roll.
Supervisor Hagman. Vice Mayor Almos.
I'm here.
Board Member Padilla Campos. Richard Dixon. Sarah Meacham is absent. Jill Wynot.
Here.
Chair Cacchiotti.
Here.
We have a quorum.
Thank you. Welcome, committee members. Let's move to our first item on the agenda.
Hagman's here. Sorry.
Sorry, Kurt. Thanks for
Hey,
getting here.
good morning.
Good morning. Go to discussion item number 1, quarterly report of investments by Sujata Jain, our Chief Financial Officer. Good morning.
Good morning, Chair, and good morning, members of the committee. Sujata Jain, Chief Financial Officer. So this first item is to report the cash balance in the LA County pool surplus and special purpose investments. As of the end of the quarter that ended on June 30th, 2025, the balance was $1,710,722,791.49. The composition of our investments are 91% in the pool surplus and 9% in special purpose investments. The earning rate for June 2025 was 3.67%. And there is a graph on page 4 that compares some yields with other entities, counties, etc. And this concludes my report. Happy to take any questions.
Great. Committee members, any questions for Sujata? Vice Mayor says no. Kurt? No. Jill? My only question, and Sujata, you know, always ask it. We have a one of our vehicles is coming up for maturity. Can you talk about that?
Correct. So Chair, the 85 million that's in Treasury that's coming up for maturity on 9/25 of this month. However, as of this report, which is as of June 30th, several others had matured. One was in July, as you can see, the 30 million, and there were a couple that matured subsequently. So we did reinvest, and we are including this 85 million at 285 million right now with LAIF, 40 million in LAIF. So when this comes for maturity, the 85 million, we will reevaluate our special purpose investments, and then accordingly with LA County Treasurer, you know, and our internal needs, we will reinvest that if we need to.
Okay. I have one more question too. Does anybody have a follow-up for that? No, see no committee members. On page, let me see, it's 12 or 13. Page 12, there's a question in the pool surplus investment paragraph. second paragraph where it starts, the pool surplus investment portfolios used to account for all pooled, go down, it says, a sentence or two down, a review of the PSI portfolio cash flow projections at the preparation date of this report indicates that longer average days of maturity may be prudent. August 2021, Treasurer increased the average days to maturity target range from 1 and 3 years to 1 and 4 years. Just brought that up for people to know. Is it any opinion or any reason why they're doing that? Anybody know?
I can reach out to them and
Okay.
get the specific answer. However, they can probably do that. I don't know if they're trying to increase their weighted average maturity and hold things longer, but I don't have a specific answer for you at this point.
That's right. Yeah, I may ask our financial manager too. Thanks, Sujata.
All right.
Is there any
Thank-
questions for Sujata? Any public comment?
No hands raised, but I just want to note that Richard Dixon is on the attendee side, but he's on the phone, so we can get him for attendance.
Thank you. Thanks, Sujata. Item number 2 on the agenda is the financial market update. Again, no motions required on this, for information only. Is Monique Spikey here?
Spike, I'm on the line. Good morning.
Good morning.
Pleasure to be with you all this morning. I will introduce myself. My name is Monique Spike. I'm a managing director at PFM Asset Management. And I've been with PFM for 22 years. I lead our California practice, serve as a member of the California Debt Investment Advisory Commission's Local Agency Investment Guidelines Review Committee, and am very happy to be able to be here with you all this morning to present the market update. So I will jump right in, and we can go ahead and advance the slide, and I'll talk a little bit about the current economy. Now, I want to preface my remarks by just noting that, things have continued to shift dramatically in the markets as a whole. You may have heard various economic indicators suggesting growth, uncertainty, the tariff policy, our trading partners, immigration. I thought it'd be useful just to sort of zoom out and talk about one of the biggest drivers of the economy, which is the US consumer. And so I thought it'd be appropriate to start here. As you may know, consumer spending accounts for 70% of gross domestic product, which means that the health of the consumer and their activity is a significant driving force behind economic growth. And so I wanted to show a couple of indicators. One, consumer confidence, how it's been faring, US credit card balances over the past few years, talk about personal savings rates and mortgage rates. Bigger picture wise, consumer confidence has softened. I think we all know that both anecdotally, and it shows itself in these numbers as well. You can see sort of the consumer confidence numbers as a whole have been dropping dramatically. If you look at the space between 2024 and 2025 on the slide, you can see a drastic decrease in confidence. Now, what is that confidence a result on? Well, one, concerns about inflation. Prices have been rising over the past few years. We've seen significant pricing increases as folks have anticipated higher tariff rates, as production supply has shifted. Other things the consumer is worried about is labor market stability. I'll talk a little bit more about the labor market in a few slides, but consumers have been feeling the concern about being able to find jobs, their pay rates, etc. Another issue is higher borrowing costs in general. Some consumers in the past years have been able to rely on home equity lines of credit, other short-term borrowing mechanisms. Those rates have remained elevated as the short-term federal funds rate has remained elevated over the years. Consumers have instead had to rely on credit cards. As you can see, the top right, credit card balances have increased significantly. And other borrowing that's not shown here, that, pay as you go, spread this payment over 12 payments. Folks are using those types of mechanisms for things as simple as groceries now. And so that is a big concern for the consumer as well. Another thing is personal savings rates have also declined, indicating that, again, consumers are relying more on credit and not savings. And then lastly, the mortgage rates have remained elevated and essentially kept a lot of folks on the sidelines. The reason the mortgage rate is so important for the consumer is that as you have new home sales, that also drives a lot of consumer spending, as consumers tend to buy things associated with a new home, whether that be appliances, furniture, outdoor equipment, you name it. And so all of this data points to a concerning reality that as the consumer remains under stress, we can expect economic data to continue to be impacted, and GDP rates continuing to be more sluggish than perhaps we would like. On the next slide, wanted to talk about CPI, which is our inflation metric. Now, big picture, quite frankly, CPI, the inflation numbers remain above the Fed's target. Core CPI, which excludes food and energy, is forecast to peak at about 3.2% year over year by the end of the year. And so we're not expecting inflation to get in line with any speed. Other things that are pushing inflation, of course, is the tariff policy. You may have heard from various policy folks that tariff price pressure will be a one-time adjustment to prices. I think the market is still trying to digest that information. Although the tariff policy has been discussed and talked about for most of 2025, it recently just started getting implemented in a real way. And so, customs goods that are coming in from overseas are starting to see the increased cost of those tariffs. Producer prices, which is another metric that actually measures the cost for folks who are bringing in material, have risen significantly. And I think it's just a matter of time before we start to see those prices push down to the consumer. Let's switch gears a little bit and start talking about the labor market. So on the next, oh, great, thank you. So the labor market is a source for significant concern right now. And one of the things that the Fed does, as you know, they have sort of two big mandates. One, to seek, good employment in the market, and two, to keep prices under control. The labor market is showing significant signs of cooling. Unemployment has edged up, and the labor force participation rate, which we're showing on the right side of this slide, continues to show just disappointing signs. August payroll gains were well below expectations. You might have heard that we only added 22,000 jobs to the market. The expectation was well above that at 75,000. And, the concern is that, the unemployment rate ticking up to 4.3%, that's the highest since October 2021. And the job creation number, that 22,000, a big concern there is that for the first time since April of 2021, the number of unemployed workers exceeds the amount of job openings. Further compounding that dynamic, of course, is the immigration situation, which is reduced, and that complicates the relationship between job openings and unemployment. Employers have continued to speak to tariffs as a concern in terms of their hiring. Other things that are impacting the employment situation, of course, is the implementation of AI. A lot of employers are talking about that as something that can, replace workers on the job. You're also hearing about AI possibly being used in manufacturing opportunities as well. And so taking that together, I think the Fed has a big job in front of them. I'll talk about the Fed in a little bit, but one of the things that is coming from some of that discussion is as employment slows, is this a time for the Fed to reduce rates to stimulate the economy? On the next slide, we talk about job openings and unemployment. And again, I'm going to make the point I made a while ago. This chart goes through June of 2025, but recent economic data shows the red line of unemployed and the blue line of job openings actually sort of converged. And so again, we have, for the first time since April of 2021, the number of unemployed folks exceeds the number of job openings. And you can see the monthly change in non-farm payrolls. A lot of this data from earlier in the year was revised downward significantly. And so the unemployment labor market picture is a lot worse than it has been. And that's something that is rolling its way through the market. And so as I started with the consumer, I'll end with the consumer here. All of this information taken together just really emphasizes what's going on with consumer sentiment and why consumer sentiment is so low. Again, I always point to sort of anecdotal evidence. You might hear folks tightening their belts a little bit more, being a little bit more cautious and conservative with their spending habits. But the reality is that things like food and energy, which is what we actually use and need day to day, continue to be more expensive than they have been, and consumers are feeling the brunt of that. You add to that price changes continue to expect to be higher over the near term. And whether we see a one-time price adjustment from tariffs or not, those higher prices will settle in for the consumer and be the reality in a lot of homes across the country. And so we're paying a lot of attention to that. The Fed is paying a lot of attention to that. And Chair Powell continues to suggest that he will rely on economic indicators to drive Fed policy, but the market is still expecting a rate cut at the meeting next week. Let's shift gears and talk about the business environment a little bit. As far as business is concerned, small business optimism has certainly softened. On this chart, we're showing a few things. Small business optimism, we're pointing to what folks cite as the biggest problem, and prices, essentially what small businesses expect to do with prices. I don't think it's a surprise to anyone that small businesses are probably bearing the brunt of the sort of tariff policy. They have less ability to eat those costs compared to some larger businesses, but small business optimism has softened significantly with owners of those businesses citing inflation as a big problem. Labor shortages is another significant problem. If you think about sort of the Main Street mom and pop businesses, you can certainly understand that maybe restaurants, hospitality businesses, even retail are having a lot of issues finding and maintaining employees in those spaces. We also have a trend of small businesses expecting to increase prices over the next few months, and quite frankly, an inability for them to increase wages. This, of course, has to do with the cost of business increases with tariffs. A recent tariff policy, too, that's going to be significant for both smaller businesses is the de minimis exception for tariff items that used to have a carve out for items that cost less than $800. That now is gone. And so, those smaller inputs, smaller items that folks were able to bring in and sell in their shops are also going to be subject to the tariff prices. And so, the small businesses are going to have some issues as well. And this all just, again, pulls into the sense of uncertainty in the markets, feeds into the consumer uncertainty as well. And so it all sounds very, dire when I speak about it, but I think it's just the reality of where businesses and consumers are right now, given a lot of the uncertainty in the broader markets. The next slide talks about producer prices, and I sort of spoke on this a little bit already, but producer prices continue to increase. Again, the cost of production, getting in raw materials, being able to source that material, and then turn it into products has just risen across the board for a lot of producers. I think the producer price increase from the latest economic releases have been shockingly high. It's not necessarily surprising, but I think there's a sense that as producer prices continue to increase, at what point do we start passing those costs along to the consumer, who in some ways has been isolated from the brunt of it? And so that's something that's certainly up for continued discussion amongst economists and market investors. So I want to talk briefly about the tariff policy. And I really like this graphic because it shows the effective tariff rate between February 2025 and July of 2025. And what I really want to point to is sort of the volatility on this chart. Every tariff announcement, every new deal that was announced and put into the market, it effectively changed the tariff rate at any given moment. And so you sort of go across the board where we started with sort of a base tariff rate of 10% on China goods. And then we started adding various countries, various types of products at various tariff rates. You can see that the tariff rate has fluctuated a bunch. When you take this into account as you think about producers and businesses, it becomes really hard to sort of plan in this environment. And so this volatility across the tariff rate really led to some of the uncertainty for businesses and their ability to plan. Then you add sort of the broader implications of various fiscal policy, budget spending, various funding freezes and the debt ceiling. It really created a lot of chaos in the market over the past few quarters. And so we saw a lot of volatility, not only in tariffs, but also in investment rates, sector spreads, etc. Right now, I think we're in sort of implementation season on the tariffs. Fed and other policymakers have, committed to seeing how it goes. But I think where we sit now is there's an expectation that prices will have a one-time adjustment, and we'll see if they continue to trend upward or not. In terms of the trade deficit on the next page, the trade deficit has increased and has come down. And a lot of the trade deficit numbers earlier in the year was because people were importing a lot of goods from overseas before the tariff rates became effective. We're essentially past that time frame now. Things are implemented. Ironically, there's been some, delays in customs for goods coming overseas because of a lot of this activity that happened. But the trade deficit has been a drag on GDP, and we expect that to resolve itself hopefully shortly. In terms of the US dollar, the dollar has remained relatively strong, which has been great in the midst of all this chaos. A lot of that strong dollar has been supported by higher interest rates overall and, global demand for safe assets. And so US Treasury still remains the risk-free asset in the market. And so there's been a lot of demand for US Treasuries across the board, which has been great in terms of shoring up the dollar in the midst of the Fed policy. Okay, so let's shift gears and talk about interest rates for a bit. So what we are showing here is the Fed dot plot. And you all have likely seen this chart before, but I think it's a great exhibit to just show where the Fed governors are thinking. Each year, includes, the 17 dots that represent each Fed member's judgment of where they think the target range should be at the end of each year. When you sort of interpret the data across the board, this data suggests that we'll see 2 interest rate cuts in 2025. And so the market is waiting very patiently for next week's Fed meeting. I think there is an expectation that we will see at least 1 cut at that meeting. I think it'd be very surprising if we saw 2. We'll see what they do, but I think if they do make a cut at the September meeting, instead of 2, it gives them time to readjust by year end if things need to be slower than this chart suggests in terms of view. Of course, added to this is the political pressure that the Fed is under from the Trump administration to be more aggressive with the rate cuts. As you know, there's a current sitting governor who is a bit in limbo, as it suggested she was removed by President Trump, and she's suggesting she has not or cannot be removed. And so that's in a bit of litigation right now, but I don't think it's going to impact what happens at the September meeting. I do think we'll see a rate cut. Continuing on in the Fed, we do have some economic projections here. There's not a lot that we can glean from these projections because they are from the differences between the March projection and the June projection. They will update these economic projections after the meeting next month, and so I'm really curious to see how their viewpoint has changed. If you glean anything from these numbers, you can see that between March and June, the Fed sort of revised their expectation for growth downward to 1.4%. And I'd say that GDP in general, I think the market as a whole is expecting growth to stagnate. We talked already about consumer confidence. We talked about tariffs. We talked about business optimism. All of those things together suggest that, the economy is under immense pressure, and we don't expect that to get better. Just some real examples, GDP grew in the first half of the year, at 1.4%, and that's about half the pace of last year. Other things, Fed still expects the unemployment rate to rest at 4.5 this year. That suggests it's going to continue to tick up at year end. And interestingly enough, on the bottom left, PCE, which is the Personal Consumption Expenditure Index, that's the inflationary figure that the Fed relies on. You can see that they increased that. And so they are showing and, saying out loud that they do anticipate that prices are going to continue to jump up. Thank you. Contributors and detractors from GDP. You can see sort of where the growth came from and where it went. Again, we still have folks holding on to private inventories. We're not seeing personal consumption. I think that's the most interesting trend on this chart. Personal consumption is in the blue, and that's consumer spending. Again, it's typically the biggest percentage of GDP. And you can see how much that blue space on the chart has dwindled significantly, and how much the export, again, as folks are revising their imports and exports to account for tariff policy, has taken over there. As the export and import situation gets resolved, we're only going to have consumer spending and fixed investment to rest on. And if you can see those trends, they're not a very healthy part of the contributors to GDP. And so this is something that folks are really going to be watching as we go along. My last few slides are going to talk about the interest rate environment, essentially like where we're investing dollars, what folks are seeing. Across the interest rate curve, I'll note that, the market has been reacting and responding a fair bit to economic data. to the tariff policy, to uncertainty in the markets. You can see here, this chart shows the Treasury curve across a couple periods. The end of July, August 18th, and then it gives you a 1-year range, essentially how much have each of these points shifted over the past year. And you can see that significant movement within a year time frame. So I think that just highlights the volatility. One thing I will say about interest rates is that, as the market locked into the expectation that the Fed would be lowering rates, you see that the 2-year Treasury, which is a great anchor point in general for California local agencies, has fallen. Other things on the yield curve is that longer term rates have come up as well. So right now, the 2-year Treasury is actually floating a little bit lower than what's shown in this chart. We're closer to 3.5%. The 10-year Treasury is at about a 4.09 right now, so a little bit steeper yield curve. I think the shape of the yield curve and it suggests that we're watching for recessionary risk. I think the other economic indicators point to that as well. But that's also a positive towards the Fed potentially lowering interest rates. And so it's sort of a bit of a catch 22 there. The next slide talks about rates in general. It shows the same information, just in table format. So I'll jump right to sector spreads, which shows interest rates amongst various sectors that local agencies in California also rely on. I'll just note that, there's been a lot of different changes in relative value. You can see that the spreads have come in across the board. In some ways, ironically, corporate fundamentals have held strong over these last few months. I think a lot of that has to do with the bigger picture expectation that regulation would soften. There'd be more opportunities for corporations to, save costs. Sadly, when corporations are making cuts to employees, they are saving on operating margins. So we've seen sort of good fundamentals from credit issuers, and that's why we've seen those spreads have a negative slope over the last year. Federal agency spreads and other types of securities have been essentially in a range for much of the year. But I think bigger picture wise, there's still some value in credit exposure for portfolio. But it is, supplemented by the fact that corporations are still doing overall relatively well, especially when you think of the bigger corporations that are a part of these indices. Okay, that's my last formal slide, so I will pause here for any questions and discussion.
Thank you, Ms. Spike. Committee members, any questions? I see Vice Mayor Brenda Almost from Paramount. Vice Mayor, go ahead.
Thank you, Monique, for the presentation. A lot of good information. Question on the labor market. Do you see, usually when we look at the labor markets of unemployment versus employment, do you know, is there a top industry right now that you see that has a decrease in job opportunities versus industry that has more?
Oh, that's a great question. Let me dig into that data a little bit more. I think the labor market, job creation in general has slowed. The industries that are being hit the hardest right now are all the industries that rely on relatively inexpensive labor. And so retail, hospitality, I think restaurants would be included in hospitality. We're seeing a decline in government hiring as well. Those industries have been hit the hardest. I think the only industries that are seeing increases in labor have been, the tech sector.
Maybe healthcare?
Healthcare is not necessarily surprisingly. The employment market is really in a free fall. And I say that not to be, like I'll go down the list, for example. 1/3 of the layoffs stem from the government sector and related industries. Retail eliminated about 64,000 jobs in the first 4 months of the year. Manufacturing and logistics have faced significant job cuts because of tariffs, cost cutting, automation. And while there have been a lot of, growth in the technology sector in a very specific area of the tech sector, mainly AI, other tech jobs have faced a lot of layoffs. Meta, Amazon, Google have laid off significant amount of workers because of the AI integration they're trying to do. And so when you put all that together, it's hard to find a bright spot in the job market. And when you think about healthcare, that's sort of being dragged down by a lot of the rural hospitals in situations like facing layoffs and budget cuts. And so it's really hard to find a bright spot in the labor market, which is unfortunate. But, there's so much uncertainty going on with tariffs. And I think it's going to take us about a year under these new policies to really shake out how it's going to work in the long run.
Thank you.
Thank you, Vice Mayor. Supervisor Hagman.
Thank you. Thank you, Monique, for the presentation. I don't want to argue numbers because I don't know anything about numbers. I definitely take exception to your conclusions in some of these things, since that's not what I'm seeing in my county. I am seeing lots of foreign investment, lots of in the billions of dollars being placed in for things. And when I talk to my local builders, I'm at the BIA annual event right now. Really, what's holding them up from really expanding their stuff is the interest rates, and which we hope that will hit more than one click going down. I'm just saying it's a shift from government spending to private sector investment is what I'm seeing on a local level. And I wanted to see what your thoughts were on, some of the other factors going into the inflation, not just tariffs, but also the cost of, fuels and other things that are going through. I get from your report, it's extremely pessimist of the future. And that's what I'm hearing from my business owners and industries that I deal with on a daily basis. I'm just trying to figure out where the misconnect is on interpretation of the facts.
Yeah, no, that's a great call out. And, I will say that there are certainly bright spots, across the country in certain localities, in certain businesses. For example, I just mentioned AI is having a great run. I think that, our presentation focuses on the sort of national picture. And when you average it out across the whole country, I think most of the indicators are pointing to negativity. But the bright side of that, and what I tried to, I tried to thread the needle at the end there, the bright side of that is, we have been in a, higher interest rate environment. In a lot of ways that has, stifled business investment, stifled the ability for folks to borrow, start new businesses, do things. As these economic indicators point to more slowed growth, that gives the Fed the fuel it needs to say, well, we do need to cut rates. We do need to provide better borrowing conditions, better investment conditions that will then stimulate the economy. So for some of these folks who are looking to make private investments, who are perhaps looking to, rent that storefront, do that renovation, hire builders, it becomes much more accessible to them. And so I think all of these things are working together to, again, give the Fed the fuel they need to make those investments or to make those changes so that folks can continue to make those investments.
And with the new tax stuff, with I'm hearing from them too, with the bill that's passed, the investment into some of these things and to build up the industries here and to depreciate stuff in a year You don't see that. And, I'm seeing the stock market go up too. I'm just wondering how we're looking at two different pictures and saying, oh, that's awful, or that's moving things in the right direction, I guess. And, yeah, I see the transition period being, it is. I talked to my importers who, we were about ready to land at Ontario Airport, a large new importer for the $800 and less. A couple days, a couple flights a day. But now because of that, that market's gone down 30%. But that's a
Yep.
shift in the economy, not a necessarily a shift in demand. It's just the way they're going to do business, how they figure out how they bring in their goods through other means, maybe on surface ship, but they're still going to pay a tariff. And now, I've seen a couple, even clothing manufacturers come back to life in my area. So I just see this as a transition period by design, versus the chaos that's kind of been reported out there. And just, I don't think it happens overnight. I think it takes time to do that.
Yeah, I would agree with that. And I think, what I want to emphasize is this all creates uncertainty. And in uncertain periods, the behavior of folks changes. And so, consumers have shifted their behavior because of uncertainty. And I really mentioned that, this tariff policy, although it's been talked about for a good part of the year, a lot of it has just been implemented. And so we don't necessarily know how it's going to work, how folks are going to adjust. But we do know that in that uncertainty, consumers have curbed their spending. Businesses with, the 800 de minimis, thing going away, as you mentioned, we've seen, some of those imports fall. We've seen folks having to pause and, really think about like what they can do to access the goods that maybe they had for sale in their stores. As they pause and rethink that, like those goods are not making it to market, those businesses are not selling product, like that has an impact. And it's going to take time to see if there is a workaround, what that workaround looks like. And then if they actually do pass along some of those costs to the consumer. We are in a transition period, but we just don't know what the other side of the transition will look like. I think there's a lot of theory out there, but until we get some, concrete evidence, I think it's still wait and see. And that's what the Fed has essentially been saying as they've been sitting, on the sidelines. They've been saying, there's a lot of theory about what's going to happen, but we actually haven't seen it turn up yet in the numbers.
Thank you, Mr. Chair.
Thank you, Supervisor. Board Member Padilla-Campos, thanks for your patience. Go ahead.
You and apologies for being late. Thank you for the presentation. I did get to hear most of it, and I would have to agree with the uncertainty that you speak about, Monique, because even me in the nonprofit world, we get a lot of our funding from foundations, and they're sort of waiting to see what happens. Not that everything's terrible, but they're just being very cautious, and that sort of has a trickle down effect, right?
Yes.
On us. So I hear what you're saying, and I agree with what you're saying. I did have a question, just because I haven't really been received. I haven't asked it, I should say. But these tariffs, where does the funding go? Or does it go to the government to then later be reinvested into the economy, or how do those funds work? Like, what is?
That's a good question. It is a tax, so it does go to the federal government. I don't think the federal government has like a set aside for like the tariff dollars. It sort of just goes into the general pot and it's appropriated as per the budget.
So no real plan for these tariffs, and are they going to be reinvested somehow into the economy? That's not anything that gets spoken about or planned.
Yeah, I think the information about the tariff, at least the way President Trump has been talking about the tariff, is that this is a new revenue source for the federal government. And so it's a net add to the coffers. And, the funds are distributed, consistent with the priorities of the budget. There hasn't been a, specific set aside, like we're going to take these tariff dollars and we're going to do this with them. It's just been more of a, hey, we're getting all this new revenue from tariffs, and that's going to allow us to carry out our budgetary priorities.
Got it. And then lastly, I know you talked about sort of the sectors that have received the largest layoffs and makes sense, but do you also see some stability on the market or those that are employed, or
Yeah, I
do
mean,
you?
I apologize for the negative bent of the presentation. It's certainly not my intent.
It's real.
But I will say though that I think that the employment market is under significant pressure, and the Fed in their projections has unemployment increasing by year end, even higher than it is right now. And so I think we expect unemployment to continue to rise. What businesses do with uncertainty is they manage their costs, and employees are the biggest expense for most industries. And so we see that happening as folks, manage their expenses. Maybe they're not getting as much traffic, whatever the case may be. And so we are seeing more layoffs. And I think we do continue to expect to see more layoffs as businesses tighten their belt as they look to plan for some of the uncertainty in the market.
Okay, I appreciate it. Thank you.
Thank you, Board Member Jill. Any questions? We need just one last one. If you could, at the next presentation, incorporate maybe one more slide on our national debt. And with that large mountain of national debt, maybe what we're paying in yearly interest payments. And finally, thirdly, as part of that, what percentage of our national budget is it? And how much is it, like 10, 11%? And where is it, number 1, 2, 3, or 4 on the list? You could.
Will do.
Thank you. Is there any public comment?
No hands raised.
Nobody here in the auditorium? We'll move on. Thank you very much, Monique.
Thank you.
You're welcome. And we've got other matters? Committee members, any other matters you'd like to bring up? See no hands raised. Staff, no. Okay, we'll move to item number 4, public comment period. The opportunity for the public to comment items that are under our jurisdiction. Is anybody in the auditorium? No. Anybody online?
No hands are raised.
Great. Then we'll go to the next meeting date is Friday, December 12th, 2025. And this meeting is adjourned. Thank you, everyone. Have a great weekend.
Take care, everybody. Take care.
Bye.
Bye.
I see you in the
Bye.
next one.
Yeah, see you in the next one.